Park Place Investment welcomes you to another episode of Investment Cubed, where we talk about the world of commercial real estate and real estate financing, Silicon Valley and technology startups, and investment and personal finance.
Hi everyone, welcome back to another episode of Investment Cubed. On today's episode, we have two great guests here to discuss their real estate impact fund and their most recent real estate acquisition. First, we have Dr. Van Williams. Dr. Williams brings his knowledge of social issues to real estate investing to positively impact the communities that the Proactive Realty Income Fund invests in. Dr. Williams has consistently repositioned rough properties over the past 21 years. As an impact fund, Dr. Williams focuses on people in the communities. In addition, the fund proactively supports affordable quality housing and seeks to encourage the development and investment into such assets. In many lower-tier communities, there tends to be blight, and many investors are not interested in rough neighborhoods due to the difficulties in asset management. Dr. Williams is a certified equity professional with a doctorate in psychology from Madison University. He also holds an associate degree in management from Ashworth College. Next, we have Michael Zajas. Michael Zajas is the Chief Investment Officer and partner at AP Capital. He worked with a private equity group right out of his master's degree in real estate development and has raised money for projects and has been a principal in development and acquisition for many projects. His expertise is often in structuring projects and working on the capital markets side of the business.
Okay, I'll go first. So I'm Dr. Van Williams, and I'm a fund manager in the private equity space. Got started in real estate in 1998, April of 1998 to be exact. I had a real estate agent, and I knew I wanted to get into real estate. Bought a property, and the property that I bought was a triplex. It was an owner finance deal. And I had a really good mentor, my real estate agent, Dave Sanderson. And I've been dealing with him for about 22, 23 years now. Next year will make 23 years. Anyway, so he taught me all the ropes about real estate investing. At that time, subject to deals were very popular. Owner finance deals, wraparound mortgages, distressed properties, investing in rough neighborhoods. So I learned a lot about real estate from him, and then that's when my real estate career kind of took off, probably, I want to say, maybe November, December of 1998, excuse me. And by the year 2000, I had probably about 18 properties in the San Francisco Bay Area. And from there, I've been working with income producing properties, and just most recently we moved into Las Vegas and did a reposition there of a 53 unit property. And so we're now here in Orangeburg, South Carolina, in a really huge mobile home park.
My background, got a real estate license 2006, and in 2010, when got a master's of real estate development, really was excited about the commercial real estate space and the, where Wall Street and Main Street meet, being at the nexus of capital and real estate. Went and worked with a private equity group right out of my master's program. We had a number of funds, and I was sort of the deal guy, onboarding the deal for the fund to invest in. So that was my first start in 2011, and I've been doing it pretty much ever since. Started a couple funds on my own, usually do kind of programmatic acquisition or development, and been a partner in a development company, and came across Dr. Van, fell in love with his business model, believe in his ability to find overlooked deals in neighborhoods that need some care, and reposition assets and keep those people that were formerly living in the building, invite them back to be residents. And I think we align on the mission, and the cash flow is really attractive. and you've got, underlying assets. And I think today, when everything is so uncertain, real estate has proven to be, and multifamily particularly has performed and been something that investors go back to. So when I had a chance to come and work with Dr. Van, it's been exciting.
I'd say we're interested in it because investing in just one property only allows us to be just in that one particular property. However, a fund allows us to scale. And our mission is impact driven, and to solve the problem of gentrification, to solve the problem of displacement. And so we thought, okay, what's the best way to do this? Okay, if we do a syndication, okay, maybe that's only 100 units or 150 units. However, if we have a fund, we can expand that across several, urban areas, several areas that need some development. And so, a lot of it was a fund was the result of us thinking about an intelligent way to deploy capital that can create high quality access or high quality housing in areas without, tearing down housing, building Class A. So like a lot of areas we invest in are opportunity zone type areas. And so we invest according to a IRR, which is an impact rate of return, which was created by Howard Buffett, Warren Buffett's grandson. And so properties that we go after, they have an immediate impact in that community. So, as soon as we start to go on a property and make some upgrades or updates, then, we can have immediate impact. So by having a fund, it allows us to have a lot more impact in a lot more places and to deploy a bottom line strategy for the fund. And so it's founded on producing double-digit market returns for investors while also creating a great deal of impact in communities that are overlooked or distressed.
I think the idea is it'll take some heavy lifting on the front end, but once there's more momentum in the fund, Dr. Van can do what he does best and really keep his nose to the street and find deals and position, Proactive Realty Fund in the best light to be able to find and close on deals quickly and be competitive and nimble. And if you're having to raise money deal by deal, it just drags everything else out. So the ability to have that discretion and decision making, and for investors to be able to kind of piggyback on his experience and his expertise, I think it's the right way to go, especially with all the deals that have been put together to date. And I think with that, Dr. Van should talk a little bit about this latest deal. It was a little bit more opportunistic in the fact that it's a mobile home park, but it checked the boxes that allowed him to service an underserved community in an opportunity zone, and provide affordable living and a path to home ownership. But it's taken a lot of work, and Dr. Van is the type of guy that doesn't mind rolling up his sleeves and putting in the hard work, kind of a turnaround specialist. So, I think it would be good for him to talk about what he's doing in Orangeburg and what the opportunity is there.
Okay, so the type of assets that are in the fund are recession resistant properties. And I don't say that lightly. When I say recession resistant, what I mean by that is these are income producing properties. So they're not properties that are part of like a strip center or a commercial or a Walgreens or, a Chick-fil-A or anything like that. These are income properties. So people live here, they sleep here. So Class C properties, some distressed B properties. Occasionally we'll get a single family in the portfolio for one reason or another. We prefer the larger multifamily properties, 50 units plus. We prefer properties that have some deferred maintenance, not so much total rehabs, but we really like to defer maintenance so we can go in and make some improvements. get the place tenanted right away. Mobile home parks, we're in a 39-acre, 187 space mobile home park currently that has city water and sewer. That's in a pure opportunity zone. And like during the pandemic, our rent collection was 100%. And that's because we're in a space that's, pretty affordable. So the average single person can afford to live here. And especially, a two member household, two income earner household can afford to live here. What else can I tell you? What other kind of property? That's basically it.
There's a focus on multifamily, and that's with renovation and repositioning of the multifamily. And Dr. Van can tell you about the other products that he layers in. And then the mobile home parks, which are more opportunistic. And the income from that includes selling new units after turning it around and then getting lot rent. So it's sort of a hybrid. You have income from selling units and then also from monthly rent of the lots.
Okay, well, so the two options are, we have a really good fixed income program of 10% paid monthly or quarterly through our third-party fund administrator, NES Financial, which has 130 billion assets under management. So on the 10% program, I need to be clear so that people don't think it's 10% per month. No, it's 10% annually divided into 12 months. So for example, investor invested $100,000, it would be $833.33 per month, or it would be $2,500 per quarter and change. And we have 3-year term, 4-year term, it just depends. The life of the fund is 7 years. So we have a couple of investors who started out and said, they agreed to 2 years, and then they saw how things were going. And they said, well, we'll see how things go. I think I might want to be in there till the full 5 or 6 years or 7 years. So, so we were okay with that. We're currently paying investors through the third-party fund administrator. Our second program starts off with a 6% preferred, but the investor has the opportunity to participate more in the cash flow upside of the properties. So each year in December, there's a 60% distribution of net cash flow to the investor that they receive, in addition to their quarterly 6% preferred. So for example, investor comes in with $100,000, that's $500 per month, or $1,500, which is paid quarterly. And then in December of each year, they get 60% of the net cash flow, which is significant given the type of properties that we go in and invest in. We don't use any additional leverage, we don't use any leverage whatsoever. So these properties are free and clear. They tend to be, more on the safe side, much lower risk, and we use the best insurance.
Yeah, and Dr. Van, why don't you talk about some of the insurance programs that you utilize in the multifamily, and how that impacts the value of the asset as well.
Okay, yeah, I'd be happy to discuss that. So what we have is we have two programs. So we have Steady, it's called Steady, STEADY, insurance program. And we also have TPP, which is Tenant Protection Program. What those programs do, they're designed to protect our investors. So say, for example, during this pandemic that we had residents that didn't want to pay rent for whatever reason, then the insurance policy would have kicked in and paid the rent for the resident. So, and they don't have strict criteria. The criteria is the resident has a minimum credit score of at least 580. They're making 2.5 times the rent, and we do our best to screen them. So it's very different from business interruption insurance, whereas business interruption insurance is if there's an interruption to the business. However, this is an interruption to the income from the resident. So it's to protect our investors from the tenants. So that's why one of the programs is Tenant Protection Program. Okay, so right now we're in Orangeburg, South Carolina, and in our PPM and our offering documents in our deck, we're in, we talk about Illinois, Ohio, Memphis, Tennessee, and Michigan. So for the most part, we're in historically tough urban areas and some not so historically tough urban areas. A lot of our properties fall either in an opportunity zone or very close to one because they're distressed areas. And like I said previously, we invest according to a IRR, impact rate of return. And so the impact rate of return is different from from a financial rate of return. Impact scoring, as I said, was created by Howard Buffett, Warren Buffett's grandson. So we go into areas in neighborhoods where we can really improve and have some good impact in those properties. So currently, we're in Harvey, Illinois. In our pipeline, we have properties in Michigan, Ohio, Memphis, Tennessee, Harvey, Illinois, Dalton, Illinois, Riverdale, Illinois, Madison, Illinois, Olympia Fields, Illinois, Stockton, California is one outside place that does not have rent control, that we're interested in, that investors can reap some really good benefits and residents too from the impact. And then here in the Southeast, we have a couple projects that have been presented to us, but we currently have about in excess of 1,000 properties in our pipeline that we're actively looking to pursue.
In the short term, just looking at the Orangeburg Park, we'd be looking for a minimum 250,000 if somebody was interested in investing in the fund or just directly in that deal. We would probably make an allowance, and we could take on another million, up to $1 million for that park to grow from 50 units to probably maybe 250 units.
Yes. Yes, sir.
So there's incredible upside in that just one deal. And then with the deals in Harvey, which is close to an Amazon warehouse that's hiring, it'll be a big job creator for the neighborhood, and should impact positively the properties in that area. We could take on probably about $500,000 just to tie up some of those properties before doing the repositioning and the renovations. So a lot of opportunity, looking for the right kind of investors, and Dr. Van can talk a little bit more about some of the investment minimums and who sort of our perfect investor would be.
Okay. So our ideal investor is one that's seeking current income and wants a safer place to put their capital. An accredited investor, we prefer one that understands real estate, understands deal making, understands the Class C space, and most importantly, understands impact investing and social impact investing. What I know for sure is that decent housing is one of the most pressing social issues of our generation, is what I do know. Investment minimum, 25,000 is our investment minimum. And for larger amounts, we like Michael said, we have the mobile home park, or we have the Harvey portfolio, or we have other portfolios, because some investors are interested in being specific. So we have no problem there. Michael.
Yeah, and the Orangeburg Park, for example, that is probably 3-4 year hold. Could go longer depending on what the cash flow looks like, but the strategy is to bring in 150 plus new units to sell through. The demand is amazing. This area in South Carolina is between Columbia and Charleston, and has been the recipient of a lot of overflow from those two cities, or out migration. And we have the ability to sell outright the units, rent to own them, or just even bring new units in that people already own and just collect lot rent but there's incredible upside in this property. And the fund should really benefit from that, and the bulk of that going back to our investors. And then with Harvey, that's definitely a couple year hold. But depending on what the cash flow looks like, it might be a longer term hold if we wanted to continue just collecting the rent and not flip out of it sooner, depending on market factors.